Silver is in T, going up right now. Silver is being repriced by a tug of war between paper liquidity in the West and urgent physical demand in the East. And the market is starting to admit it in the only language it can act fake for long, spreads premiums and forced positioning. The conflict is immediate and it's deliberate. When price starts behaving like a scarcity asset, the system's first response is to tighten the leash, raise margins, pull liquidity, punish leverage, and see who blinks. But here's the hidden detail most people miss. And it was the reason this $100 silver in China headline is not just clickbait. The spot chart can look like a coin flip while the physical market is quietly paying up right now in size. And if one level breaks again, the math changes fast. Stay with me, because by the end, you'll have three things most traders never get. The one mechanism that turns a premium into a vault drain, the calendar trigger that makes the next week or two unusually dangerous and unusually opportunistic, and the exact checklist that tells you whether $100 is a magnet or just a number that gets used to bait your FOMO. Start with where we actually are, not where the narrative wants you to be. Silver didn't gently climb into year-end. It exploded, printed into the low to mid-80s at the highs, and then snapped lower into the low 70s in a matter of hours. Exactly the kind of move that makes smart people look dumb and dumb people feel smart, right up until the next candle. And that whiplash is not a side story. That whiplash is the mechanism. Because when an exchange raises collateral requirements during a volatility surge, it doesn't matter whether you're right about silver long term. If you're levered, you either post more cash immediately or you become forced selling. That is the part retail always underestimates. The market doesn't have to beat your thesis. It just has to beat your margin. And when that happens, price can fall violently even as physical tightens. That's where the real pressure starts. Now zoom out one notch and notice what's weird about this particular moment. Silver is not just a precious metal trade right now. It's just sitting at the intersection of three flows that don TL like each other. Macro money chasing a regime shift, industrial procurement trying to secure inputs, and market structure trying to contain volatility. Macro money sees rate cuts, a weaker dollar, and the hard asset reflex. Industrial procurement sees lead times, inventory buffers, and the ugly truth that you can't run a factory on a chart pattern. Market structure, dealers, futures, clearing, sees risk limits and tail events. So when price runs, the structure tightens. When structure tightens, weak hands get liquidated. When weak hands get liquidated, price dips. And when price dips, the physical buyer, especially the one that is undersupplied, steps in and quietly pays up. This is why a market can look manic on the screen while it's actually getting tighter underneath. But that's not the part that matters. The next detail is what flips the whole setup. If you want to understand $100 silver in China, stop imagining that the Shanghai market is literally printing a clean, global, universally deliverable $100 spot quote that everyone else can arbitrage instantly. That's not how this works. The story is about dislocation. It's about all-in prices, local benchmark, taxes, fabrication, availability, delivery window, and it's about a physical premium that gets big enough to pull metal across the world. If the West is trading $72 and a physical hub is effectively paying $78, $80 or more for immediate metal, that gap is not a curiosity. That gap is a signal. Because a $6 to $8 premium on a $70 metal is not noise. That's a near double-digit premium. And double-digit premiums don T exist for long unless something is tight in the only place that matters, deliverable availability. And once that premium exists, somebody has to do something. Somebody has to source. Somebody has to ship. Somebody has to finance. Somebody has to cover a short they assume they could roll. And that guess, when iVault's being drained, stops being a slogan and starts being a mechanical consequence. Because if this one pressure point persists, the paper price gets dragged, whether it wants to or not. Here's the plumbing in plain language. Silver trades in multiple arenas at once. There's the futures benchmark, deep, levered, fast. There's London OTC, massive, opaque, built on a system of allocated bars and unallocated claims. There are vault networks where bars sit and where ownership miles can mean wildly different things depending on whether a bar is specifically assigned to you or simply owed to you. And then there are physical delivery hubs where an industrial user or a refiner or a fabricator can just settle with paper exposure. They need metal. They need it in a specific form. They need it on a schedule. So when those physical hubs start paying more than the futures benchmark, it's not because they love paying more, it's because they're buying time, certainty, and actual availability. And that's where the hidden detail lives. The price is lying, and the spread is telling the truth. Now let's make spread real. In normal conditions, the front end of a futures curve often trades a touch above spot, because storage, financing, and convenience yield balance out. But when you see signs of backwardation, When near-term physical is bid above what paper would imply, it suggests the market values now more than later. That's a scarcity signal. It says immediate supply is tighter than the paper market wants to admit. That doesn't mean the world has run out of silver. It means the easy silver, the silver that can be mobilized quickly without disturbing someone's long-term holdings, is getting harder to find. And when the easy silver disappears, the cost of borrowing metal rises, the cost of obtaining deliverable bars rises, and the market becomes more sensitive to any additional demand shock. Because if the float is thin, price has to do more work. And that's when moves start coming in steps instead of slopes. Let's talk about Western vaults being drained, because this is where people get sloppy and lose credibility. The LBMA publishes London vault holdings data. The headlines can say holdings went up or down month to month. That's useful. But it can mislead you if you don't understand the difference between metal in the building and metal available to meet urgent demand. A vault can hold a mountain of silver and still be tight if most of that silver is spoken for, allocated to ETFs, locked by long-term holders, pledged, or simply not for sale at any price that the market currently offers. The market's stress shows up not in the total tonnage number alone, but in the availability of tradable float and the cost of mobilizing it. That's why you can see inventory numbers that look stable while borrow stress screams. Because availability is a category problem, not a counting problem. And that's the part retail doesn't model. Because the chart doesn't show you which bars are available. The chart only shows you what the marginal unit costs. So how does East demand drain West liquidity without any cartoon villainy? Through arbitrage. Here's the chain reaction. A physical hub in the East starts paying a persistent premium for immediate delivery. That premium attracts traders and intermediaries who live for basis trades, buy where it's cheaper, sell where it's richer. But you can't do that trade with a meme and a brokerage app. You need financing, you need metal that meets local specifications, you need a delivery route, you need time, and you need confidence that the premium will still be there when the metal lands. In a calm market, those frictions keep premiums contained. In a stressed market, the premium grows because the frictions become the bottleneck. And when that premium gets large enough to pay for the frictions, fabrication, shipping, insurance, financing, metal starts moving. Not because someone planned a drain, but because the market always migrates toward the best bid, and physical bids are sticky. They are tied to real consumption and real procurement. That's why this is dangerous for shorts. Because paper can be rolled. Physical has a date on it. And now we hit the calendar trigger because this is the week where calendar mechanics stop being trivia and start being gasoline. You're at year end and into the first turn of the new year. Liquidity is thinner than it looks. Risk desks are tighter than usual. And after a huge move, exchanges respond with margin hikes to reduce systemic risk. That combination is why you can get a 9% drop and a 10% rebound, like it's nothing, because it's not just buyers and sellers. It's forced behavior, it's collateral calls, it's funds de-risking, it's dealers widening spreads, it's traders reducing size because the cost to hold exposure just went up. And when margins rise, that forces liquidations first, and it invites dip buying second. That's the cycle. And that's why the next week or two matter. You're likely to see more air pocket moves in both directions. Not because the thesis changed, but because the collateral regime changed. Because if one level breaks, the math changes. Now add the other calendar layer. China's seasonal demand patterns around the Lunar New Year. Ahead of that holiday, procurement and stocking behavior can change. Logistics schedules compress, demand can get front-loaded. And when you combine that with a physical premium already flashing, it creates a window where the physical bid can get even more aggressive, even if the paper market is busy liquidating. That divergence is exactly how dislocations widen. Paper sells because margin, physical buys because necessity. If you've never watched that movie before, you will misread the chart and miss the signal. And that's why we're doing this the right way. Mechanism first, emotion last. Let's break down the forced behavior at the center of this, margin and options. Most people talk about short covering like it's a moral event. It's not. It's a mechanical one. When silver runs, short positions lose money. If they are futures shorts, they post variation margin daily. If price jumps too far, too fast, they need cash now. If they don't have it, they cover. That's not panic, that's clearing. Now layer options on top. Dealers who are short calls must hedge their exposure as price rises. If the market is in a zone where dealer positioning creates positive gamma for buyers, moves can accelerate because the hedging itself becomes buying. This is why you see step moves and sudden verticals. It's not emotion, it's math. Price rises, hedging demand rises, price rises more. Then when the exchange tightens margin and volatility spikes, liquidity providers step back, spreads widen, and a small wave of selling becomes a big drop because there's no depth. That's why the same market can rally and crash in the same week while still trending bullish in the bigger picture. But the next detail is what flips the whole setup, how physical tightness interacts with those forced flows. Here's the key. Paper volatility creates windows where physical buyers can secure metal at a discount relative to their local urgency. If Shanghai is paying a premium, a paper flush becomes an opportunity for anyone who can finance and move metal. That's why the premium matters more than the tweet. Premium is the real bid. Premium is the market saying, I will pay to have it now. And when premiums persist through a paper flush, it means the physical bid is not price sensitive in the way the speculators are. That is the definition of a regime shift. The marginal buyer changes from momentum money to needs-based demand and strategic stockpiling. And when that happens, upside moves become sharper and downside moves become more violent, but shorter-lived, because the dip gets bought, but it also gets used. Volatility becomes the weapon. Now we need proof stacking because one signal is never enough in a market this emotional. So you stack evidence across market structure, supply chain, institutional flow, and macro. First layer, price context. The market printed record highs in the 80s and then snapped back toward the low 70s on margin-related pressure and thin liquidity. That's real. Second layer, regional dislocation. Reports of Shanghai physical pricing, trading at a notable premium over Western benchmarks, with backwardation signals, meaning immediate physical, in that hub was bid above futures implied levels. Third layer, vault data context. London vault holdings are large in total, but the key insight is that total holdings are not the same as available float. In tight conditions, the tradable portion shrinks and borrowing becomes more expensive. Fourth layer, industrial demand fundamentals. The Silver Institute has described record industrial demand and repeated market deficits in recent years, driven by electrification, electronics, solar, and broader industrial consumption. That doesn't mean instant shortage tomorrow, but it does mean the baseline demand is not a meme. Fifth layer, institutional flows and behavioral feedback loops. When ETFs see inflows during a momentum phase, they vacuum metal and tighten availability. When those flows reverse, volatility spikes and creates forced liquidation, yet physical demand can absorb dips. Sixth layer, macro regime shift. Rate cuts, dollar weakness, and geopolitical uncertainty pull capital toward hard assets, while industrial demand keeps the floor firmer than the skeptics expect. You don't need all six to be perfect. You need enough of them pointing in the same direction that the thesis survives the noise, and that's the difference between conviction and delusion. Now let's address the counterpoints, because trust comes from admitting what could break this. The loudest counterpoint is that this is a speculative blow-off, a bubble driven by leverage and hype, and the market will mean revert brutally. That is plausible, and you'd be irresponsible to ignore it. Another counterpoint is ratio analysis, silver versus oil, silver versus industrial inputs, silver versus rates, metrics that sometimes flash overheated. If silver has run so far that it's historically expensive relative to certain economic comparables, that can signal vulnerability to a sharp retracement. And the market has already shown you it can drop 8 to 10% in a day. That's not a theoretical risk, that's a lived risk. So the only credible stance is not guaranteed moon. The credible stance is, this is a structurally tight market that can still punish you violently. And the path to $100 is not a straight line. If it happens at all, it happens through volatility. And that's where the psychology shield matters. Because here's how you get manipulated in a market like this. First, they give you the vertical. That triggers FOMO. You feel late. Then they hit you with the margin-driven flush. You feel stupid. Then they bounce it hard. You feel desperate to make it back. That's the emotional trap. Late entry, panic exit, revenge re-entry. The market doesn't need a conspiracy to do this. The structure does it automatically because leverage concentrates risk and collateral regimes force behavior at the worst moment. The shield is simple, but it requires discipline, separate trend signal from noise. Trend signal is the higher structure. Does price hold above key breakout zones? Do dips get bought? Do premiums and spreads stay elevated? Noise is the intraday flush that exists because margins changed and liquidity thinned. If you treat noise like signal, you will churn yourself out of a correct thesis. If you treat signal like noise, you will hold through invalidation and call it conviction. The goal is neither. The goal is a plan. So let's get concrete with the plan. You need levels and you need conditions, not vibes. In the near term, the market has a clear ceiling zone, the region near the recent highs in the low to mid 80s. That zone matters because it's where volatility spiked, where margin pressure intensified, and where any renewed push could trigger forced hedging and short covering again. If silver reclaims that zone with momentum, you're in the continuation lane. Below that, you have the battlefield zone around the low 70s. Call it the region the market is currently fighting over. If that zone holds on pullbacks, it suggests dip demand is real, not just speculative. And beneath that, you have the prior breakout and retest region, Think of the high 50s to low 60s area that marked the earlier regime change when silver first made the leap into record territory. A hard break back below that region would be a serious thesis wound, because it would imply the move was more blow-off than repricing. This is not about predicting the next tick. It's about knowing what would have to be true for your story to remain true. Because if one level breaks, the math changes. Now let's translate those levels into the two-scenario lens that keeps you honest. Scenario 1 is the controlled pullback and retest. In this lane, silver chops, whips, and bleeds volatility out of the system. You get ugly days. You get fake breakdowns. But the structure holds. The lows stop falling. The market defends key zones, and the physical signals, premiums, backwardation tendencies, borrow stress, do not collapse. In this scenario, the market grinds higher after it tortures the largest number of participants. That's the slow burn path where $100 is not tomorrow's candle. It is a later magnet that becomes plausible only after the market rebuilds a base above the new regime level. Scenario 2 is the continuation squeeze. In this lane, the market refuses to give you a clean entry. Dips are shallow. Spreads stay tight in time but wide in dislocation, meaning the physical premium persists. Price pushes back toward the highs, and as it breaks above key strike concentrations and prior highs, hedging and short covering become fuel. This is the lane where gaps happen, where overnight moves appear, where you wake up to a print you didn't think was possible. And it's also the lane where the snapback can be vicious, because once the squeeze exhausts, margin and profit taking can drop the market $10 in a day. Both lanes can lead toward $100 eventually, but only one lane does it in a way that destroys undisciplined traders. And the market loves that lane. So what confirms which scenario we're in over the next week or two? Don't guess. Watch the signals that force behavior. Watch the front-end structure. Does near-term tightness persist, or does it relax? Watch regional pricing. Does the east-west premium stay elevated, or does it compress sharply? Watch volatility and liquidity. Are intraday dumps being immediately absorbed, or are they cascading into multi-day liquidation? Watch positioning indirectly. When price rises, does it feel effortless, like there's no offer, or does it feel labored, like every rally is sold? And watch the calendar. New Year liquidity normalization, any additional margin adjustments, and the approach to delivery expiry windows that can tighten the front end. These aren't mystical signals. They're incentives. They tell you what participants are being forced to do, and that's the only reliable information in a market this loud. Now, about that Western vaults are being drained claim. Here's the sober version that actually holds up. London vault holdings can be large and even rise in a given month, and you can still have a tight market if the metal is not freely mobilizable. The drain people feel is often the drain of float, the portion of metal that can be sourced, borrowed, swapped, or delivered quickly at a reasonable cost. When demand rises and deficits persist, more metal gets locked into long-term hands. When ETF and institutional interest rises, more metal gets allocated. When industrial demand rises, more metal disappears into supply chains that don't return it quickly. That is how you get a market that feels tighter even if the headline inventory number doesn't collapse. And when a physical hub pays up, it doesn't need to empty the vault. It only needs to absorb the float, because once float is thin, price becomes sensitive. The marginal bar sets the price, not the total bars in existence. And that's why premiums matter. This is also why the phrase paper versus physical is not a moral argument, it's an operational one. Futures markets are designed for price discovery and risk transfer. They can trade volumes that dwarf physical turnover because most contracts are netted and closed, not delivered. That's normal. But in a stressed moment, when enough participants want delivery or want guaranteed access to a physical, the system becomes sensitive. Deliverable categories matter. Not all inventory is deliverable. Not all inventory is willing. And when the demand for certainty rises, the premium for certainty rises too. That premium is the market's stress indicator. And when the premium rises, it invites arbitrage. And when arbitrage activates, metal moves. And when metal moves, the West feels the drain. That's the loop. And that's why the $100 idea has teeth. It's not a prediction. It's an outcome that becomes plausible when dislocations persist long enough to force repricing. But let's be precise about what $100 really means in a credible framework. $100 is not a magical fair value. It's a psychological level, a strike magnet, and a headline generator. If the market is currently around the low 70s after touching the 80s, you don't get to $100 by politely adding $1 a week. You get there through a combination of sustained tightness, a trigger that forces hedging and covering, and a period where physical demand refuses to let dips go cheap. That can happen. It can also fail. The point is not to marry the number. The point is to track the pathway that makes the number possible. And that pathway is elevated premiums, tight front-end structure, constrained float, and a macro backdrop that keeps capital rotating into hard assets. Remove two of those, and $100 becomes a fantasy. Keep 4 of those, and $100 becomes a magnet that the market can sprint toward faster than most people think, especially in thin liquidity. Now, I want to give you the single most practical takeaway. The market will try to make you trade your emotions, not your plan, and silver is uniquely good at it because it lives between two identities. It is precious and industrial. It is safety trade and growth trade. It is inflation hedge and technology input. That split identity means narratives will swing wildly depending on the day's headline. One day it's safe haven, the next it's bubble. One day it's supply shortage, the next it's speculative mania. Your job isn't to pick a tribe. Your job is to watch what participants are forced to do regardless of narrative. When margin goes up, leverage gets squeezed. When physical premiums stay high, procurement is urgent. When the curve tightens, immediate supply is valued. When price reclaims highs, hedging can become fuel. Those are not opinions, they are mechanics. And mechanics is where money is made or protected. So here's how you navigate the next 2 weeks without getting harvested. First, respect volatility. Price can whip around violently, even if the thesis is correct. That's not a warning to be scared. That's a warning to size correctly. Second, identify your invalidation. If you don't know what would make you wrong, you don't have a thesis, you have hope. Third, stop letting single candles rewrite the story. If you're watching a market that can move 8% after a margin announcement, you do not treat an intraday wick like a divine message. You treat it like liquidity, leverage, and forced flows doing their job. Fourth, watch the physical tells. If you hear tightness, but premiums collapse and structure normalizes, the story is weakening. If you hear bubble, but premiums stay high and dips get vacuumed, the story is strengthening. And fifth, remember the calendar. Thin holiday liquidity is leaving, but the aftershocks of margin adjustments and the positioning reset can echo into early January. That's when most people get chopped. They assume the headline, move is over, and then the market makes one more violent move to clear the remaining weak hands. And that's where the real pressure starts. Now let's talk about what comes next looks like in practical terms. If silver holds the low 70s region and starts building higher lows while physical dislocation remains, you should expect another attempt at the highs, because the market has already proven it can trade there, and markets love to revisit extremes after a liquidation flush. If silver loses the low 70s cleanly and can't reclaim it, you're likely in the controlled pullback lane. And the market may seek a deeper retest zone to reset positioning, potentially toward the mid to high 60s or lower, depending on how violent the liquidation becomes. That doesn't automatically kill the long-term thesis, but it changes the time frame and it changes the risk. If silver reclaims the upper 70s quickly and presses toward the low to mid 80s, watch how it behaves near those prior highs. A clean break with momentum can trigger the squeeze lane. A failure and sharp rejection can trigger another margin-driven flush. And yes, both can happen in the same week. That's silver. That's why you don't trade it like a sleepy asset. You trade it like a market that can turn your confidence into a liability. And finally, the question everyone cares about, is this really the start of a move toward $100, or is it the peak of a mania? The honest answer is that it can be both in different time frames. A market can be structurally tight and still be locally overextended. A market can be in deficit and still be in a bubble phase for a few weeks. Those statements aren't contradictory. They're a reminder that timing and positioning matter. The way you protect yourself is by refusing to be seduced by certainty. You don't need certainty. You need a checklist. If premiums persist, if the front end stays tight, if dips are bought above key regime levels, and if a push through prior highs forces covering and hedging, then $100 stops being a meme and becomes a magnet. If premiums collapse, if the curve normalizes, if price loses the key regime zone and stays below it, then the $100 talk was primarily a narrative weapon to lure late buyers into a volatility trap. And you can watch that unfold in real time without guessing, because the market will tell you, just not in the headline. So here is the subtle community challenge before we wrap. Donnie, tell me your price target. Tell me your signal. Tell me what you're watching that would make you lean into the move or step aside. Premiums, curve structure, a specific level on the chart, margin-driven flush behavior. Because that's the identity of a serious participant. Not the loudest prediction, but the clearest process. Keep your eyes on the spreads, respect the calendar, and don't let volatility rent space in your head for free. Because in the next week or two, silver is going to offer you one of two gifts. A clean retest that builds a base, or a squeeze that punishes hesitation. And whichever one shows up, you'll be ready, because you're not trading a story. You're trading the mechanism.